All right, let's look at the data. Because right now, there's a structural battle happening over market information. And if you're not paying attention, you're basically trading with one hand tied behind your back. The rules of the game are literally changing under our feet.
You see, since 1975, this has been the magic number for transparency. Any fund managing over $100 million, well, they've been required to file a quarterly report showing all their long stock positions. This has been a foundational data set for decades.
But now, the SEC is proposing a 35-fold increase, raising that threshold to a staggering $3.5 billion. Now, let's be clear, this isn't just some minor tweak, it's a massive regulatory anomaly. It's designed to fundamentally change the entire flow of public market data. And to really put a fine point on it, this isn't a small adjustment. This proposal could completely eliminate the public filings from nearly 4,500 investment managers. For you, the retail trader, this isn't just creating some information fog. No, it's a potential data blackout.
So let's break down what this data actually is and why losing it represents a fundamental shift in the market's microstructure. You know, the very plumbing of how stocks are traded and priced every single day.
The data set at the very heart of this whole thing is something called Form 13F. For years, it's been the go-to tool for what we call whale watching, tracking the moves of the biggest, most influential players in the market.
I want you to think of this form as the sonar of the market. It lets us detect the movements of these huge influential funds, the whales, as they're accumulating or dumping massive positions way down below the surface. It's an absolutely foundational piece of public market intelligence.
And look, this data isn't just for Wall Street analysts. As you can see from this query, sharp retail traders use it to spot patterns, to see where there's real conviction. It's all about using those institutional flows as a signal to find high-conviction ideas from the smart money.
So this change, it threatens to switch that sonar off for a huge chunk of the market. It would especially hide the moves of those smaller, more nimble funds that often act as canaries in the coal mine. Following the money? Well, it's about to get a whole lot harder.
Now here's where it gets really interesting. Here's the paradox. Just as institutions are lobbying for less transparency on their long positions, retail traders are fighting for more transparency on the other side of the trade, the shorts.
You've got advocacy groups like We the Investors leading the charge. They're fighting for much greater transparency, especially around the really opaque world of short positions, which has pretty much always been a blind spot for the public.
And right here, you can see the two opposing forces in this information war, plain as day. On one side, institutions want to protect their strategies by reporting less. On the other, retail wants to level the playing field by demanding more light on short positions and derivatives. It's a real tug-of-war. And the stakes in this battle? They are incredibly high. We saw a perfect example of this play out during the recent meme stock rallies, where publicly available short interest data was the actual catalyst for a massive market anomaly.
So check this out. In mid-2025, the real estate platform Opendoor had a gigantic short interest of around 21% of its total float. That is a huge, publicly reported number that signals extreme negative bets from institutions.
This high short interest created what was basically a coiled spring. For organized retail traders, this wasn't just bearish sentiment. It was a bright, flashing target. The setup for a classic short squeeze was sitting there in plain sight for anyone who was looking. And the result? A massive wave of collective buying pressure that forced short sellers to cover their positions, which drove the share price up over 500% in a single month. This just goes to show you the explosive market-moving power of publicly available data. Okay, so if that traditional institutional data is getting harder to come by, where do retail traders find their edge? Well, the answer is all about adapting the toolkit. You see, agile traders are adapting. They're not just complaining about losing the data, they are pivoting. They're focusing on alternative, high-signal datasets that institutions can't easily hide or obscure. And there are two data frontiers that are becoming absolutely critical. First, filtering insider transactions. And I don't just mean looking at buys. I mean identifying true, high-conviction open market purchases with their own cash. Second, the systematic, algorithmic analysis of social sentiment to really quantify the voice of the crowd. And this all builds into a new, actionable framework. The strategy is to filter for those high-conviction insider buys, then analyze social sentiment to find any strange divergences, and then you correlate the two.
That alignment of smart money and crowd conviction, that's where the edge is found now.
So what does this all mean for the future of trading? It's pretty clear we are in a new era of information arbitrage, where the advantage itself is shifting.
So here's the outlook. The bull case is that technology is democratizing analysis and empowering the agile trader. But the bear case? Well, the bear case is that institutions are using these regulatory changes to rebuild their information walls and preserve their structural advantage.
And that really brings us to the key takeaway. In this new battlefield, the most valuable asset is no longer just having access to data. No, it's the skill to filter, to analyze, and to adapt to the ever-changing flow of information itself. That's the game now.
We're tracking these flows in real time. While you analyze the next move, check out the tools in the description. You can sign up for Public to get $20 in free assets, check Webull for that BTC promo, or look into NVDA on Moomoo. All the links are down below. And hey, like and subscribe for more deep dive analysis.
And just a final reminder, this analysis is for educational purposes only, and it's based on current data, which changes incredibly fast. So always conduct your own due diligence. Stay disciplined, stay liquid.